I'm about to show you a scalping strategy so simple it only needs one candle to work. No complicated indicators, no chart clutter, just a single 4-hour candle that sets up multiple high probability trades throughout the day. I tested this on Bitcoin, Forex, and gold, and I'm going to show you every single trade, the wins and the losses live on the charts. By the end of this video, you'll have a complete 3-step system you can start using today. But here's the catch. Miss any of these 3 steps and the whole thing falls apart. Let's get started. First, let's understand the psychology behind this strategy. At the beginning of every trading day, big players don't chase price. They build a range, a zone where price is allowed to move while liquidity is being collected. That range is clearly shown by the first 4-hour candle of the day. Now let me switch to the 5-minute chart so you can clearly see this 4-hour candle price range marked here. The high and the low of that candle become important boundaries. This is where institutions observe order flow and wait for retail traders to make mistakes. Now here's where most traders go wrong. When price breaks above or below this 4-hour range, retail traders immediately think, okay, the move has started. They chase the breakout. But in reality, most breakouts fail. Price often breaks the range just to trigger stop losses and trap late buyers or sellers, and then it snaps right back inside the range. That move is called a false breakout, and that false breakout is not random, it's intentional liquidity. The strategy is built around that idea. We are not trading the breakout, we are trading the return back into the range. Instead of buying highs or selling lows, we wait for price to show its hand, trap the impatient traders, and then we step in from the smarter side of the trade. That's the edge. Now open your chart and switch to the 4-hour time frame. Critical step here, set your time zone to New York time in the bottom right corner. This ensures everyone's using the same reference point. Find the first 4-hour candle that formed today and draw horizontal lines at its high and low. Extend these lines to the end of the day. That's your playing field. Wait for this candle to fully close before marking anything. If it's still forming, you're too early. This is crucial because a forming candle can still change dramatically. Now, switch down to the 5-minute chart. Now you're hunting for 2 specific things in this exact sequence. First, a 5-minute candle that closes outside your range. Not just a wick poking out, but a full candle close beyond either the high or low line. Wicks don't count, the body must close outside. This is the false breakout we're waiting for. Second, price must re-enter and close back inside the range. This is your confirmation that the breakout failed and traders are trapped. This is the signal that price is rejecting that level. Both of these must happen on the same day you marked the range. Once the day ends, you reset and mark a new range for the next day. Here's where it gets interesting. If price broke above the range and came back in, you go short. If it broke below and came back in, you go long. You're fading the breakout and trading with the trapped trader's pain. Stop loss? Place it at the extreme of the breakout candle, the exact high or low where price broke out. This protects you if the breakout actually continues. Take profit, 2 times your stop loss distance. This gives you a 2-to-1 reward to risk ratio, meaning you only need to be right 40% of the time to be profitable long term. Let me show you exactly how this looks on real Bitcoin charts. Here on the Bitcoin 5-minute chart, we have our 4-hour range marked. Watch what happens here. Price drops and closes below the range low. See this red candle? It completely closed below our line. Now we wait. And here, this green candle closes back inside the range. That's our signal. Entry, long position right here at the close of this candle. Stop loss, placed at the exact low of the breakout move right here. Take profit, 2 times the distance marked here. Now let's see what happens. Price moves up and boom, hits our take profit target perfectly. That's a clean 2R gain, 1 trade, double our risk. Same day, different opportunity. Price is now trading higher, and look, this candle closes above the range high. That's our first condition met. Now we wait for re-entry, and here it is. Price closes back inside the range. Entry, short position at this candle close, stop loss. At the high of the breakout candle, right here, take profit, 2 times risk, set here. Watch the price action. It drops steadily and hits our target, another 2R profit. This is the power of trading false breakouts. The momentum is already on our side. Now, here's a trade that didn't work. And I want to show you this because losses are part of trading. Look at this setup. Price broke below the range, then closed back inside. Textbook setup. We go long, stop loss at the lows, take profit at 2R. But watch what happens. Price moves up initially, looking good, but then reverses hard and hits our stop loss. That's a 1R loss. And this is important. Not every trade wins, but because we're risking 1 to make 2, we can afford to lose and still be profitable overall. Here's the crucial insight. You don't need a 90% win rate to be profitable. With a 2-to-1 reward to risk ratio, you can win just 40% of the time and still break even. Anything above that is pure profit. This strategy averaged 72% across all markets. That's powerful. Here's a scenario you'll encounter often. Price makes a massive drop below our range, way beyond the low. If we placed our stop loss at the extreme low here, it would be huge, maybe 50 or 60 pips. Oh, that's too much risk. Instead, look for the nearest key level. See this small support level here? That's where we place our stop instead. This keeps our risk manageable. Take profit still at 2R from our adjusted stop, and look at that. Price rallies back up and hits our target perfectly. Another 2R gain with controlled risk. Pro tips to improve your results. 1. When you see a massive breakout, price shooting way beyond your range, don't blindly place your stop at the extreme. Look for the nearest key support or resistance level or an order block and use that instead. This keeps your risk reasonable. 2. You can take multiple trades per day from the same 4-hour range. Don't think one range, one trade. If price keeps breaking out and re-entering, keep taking the setups. 3. Combine this with trend analysis. If the overall daily or weekly trend is up, favor the long setups over shorts. If the trend is down, favor shorts. This simple filter can boost your win rate even higher. This is the basic version of the strategy, and it's designed to work across different markets because it's based on market behavior, not predictions. The real strength comes when you combine it with tools like volume, market structure, or trend context. But even on its own, the logic holds, because one thing remains true across all markets. Not every breakout follows through. Most traders react emotionally. They chase price. This approach does the opposite. It waits for confirmation and focuses on logic over excitement. Before applying this live, here's what I recommend. Test it properly. Take at least 20 to 30 sample trades. Track your entries, exits, and outcomes. Pay attention to how it fits your execution style. Losses will happen. That's part of trading. What matters is how the strategy performs over a series of trades, not one result. If you want to learn how I personally study the markets and apply concepts like this, hit the like button and subscribe for more educational trading videos. Thanks for watching, and I'll see you in the next video.